Hi, Mike Wright here. It's the 9th day of Christmas, and I want to speak to you about 9 things that are different today, or maybe aren't different, than they were 2 days ago before Congress passed its fiscal cliff legislation. First thing I want to let you know is that while we did avoid the cliff, there are still some significant potholes that you need to be aware of that we might run into on an ongoing basis. First thing I want to mention is that taxes went up for everyone earning less than $113,700 because that's the cutoff, the cap for Social Security taxes, and those taxes increased by 2% across the board. This is because of the end of the payroll tax holiday. There was no attempt made in this legislation, and there's no legislation available right now that would indicate that this is likely to be restored, so you can depend on this 2% increase to continue. Second item was that the top tax rate increased from 35% to 39.5%. This applies to people whose incomes exceed $400,000 individually or $450,000 joint. In addition to that, the capital gains rate was increased on those same people to 20%. Now, this does not affect anyone below that $400,000 threshold. Those rates will remain at 15% for most and 0% for those whose underlying tax rate is 10 or 15%. However, unrelated to the congressional bill, there's also the tax imposed by the Affordable Care Act to pay for Medicare of 3.8% on investment income. Now, that particular tax applies to investment people whose incomes exceed $200,000 or $250,000 filing joint, and that's not just $200,000 of capital gains, that's $200,000 in total income. So for those people earning $400,000, the effective capital gains rate for them becomes 23.8%, or almost a fourth of their income, just for the capital gains portion of that. There's also imposed by the Affordable Care Act a 0.9% Medicare surcharge on everyone whose income exceeds $200,000. And as you know, Medicare taxes are not capped by an income amount, so that's just a 0.9% increase for everybody with that higher income. Also, at a different income level of $250,000 for an individual, we'll begin to see the phase out of itemized deductions and personal exemptions. These will be done by percentage, and as your income goes up above the threshold, the amounts that you can deduct in those areas or the personal exemption that you get continues to go down. Then the seventh item is the impact of the alternative minimum tax adjustment. Every year Congress has had to reduce or patch the alternative minimum tax bill to account for inflation. Well, in this bill, surprisingly to everyone, the current adjustment for inflation was made permanent for the future. For 40 years Congress has had to make that patch, but now we won't have to worry about it as time goes on. In fact, everything that I've mentioned to this point has become a permanent part of the law instead of being something that has to be renewed or stuck in when time comes. Of course, you do need to remember that permanent in American tax parlance simply means it stays that way until Congress decides to change it. The eighth item that was included in this bill was the continuation of the $1,000 child tax credit, and also the continuation of the relief from the marriage tax penalty, or the marriage penalty rather. As you know, that has to relate to such things as standard deductions and so forth, which instead of being made higher for a married couple are simply the same as two single people together. So there they are, 9 things that have changed. Oh, there's more than these 9, but these seem to be the most significant. There are other things that we'll talk about in the future, other things that you need to know on an ongoing basis, but these are the most important, and some of these will begin to affect your paycheck the next time you get one. So until tomorrow, wishing you a continued Merry Christmas.